Hi there, traders and investors. Welcome to Strike. We deep dive into tools that can help you enhance your trading and investment strategy. Today, we'll be focusing on MACD indicator, which is a great tool for trend following. Stick around to find out how you can use this indicator in your trading strategy. MACD or moving average convergence divergence was created way back in 1970s and it has stood the test of time. It shows a relationship between two moving averages. Here on the chart you can see the blue line which is known as the MACD line weaving its way through the price action. Now this particular line is going to tell us a lot about the future price action as well as the momentum in the stock. So stay tuned for that. So let's come to the calculation of MACD and the components. So the first component is the blue line which is known as the MACD line. It is nothing but the difference between a fast moving average and a slow moving average. So in the default MACD settings, it uses the difference between 12-day exponential moving average and 26-day exponential moving average. Now for your reference, I have applied both of these averages on the chart. The light blue color here is the 12-day and the dark blue one is 26-day moving average. Now what you're seeing is in a continuous trend, the faster moving average tends to stay above the slower moving average. So what you can see here is in an uptrend, the faster moving average is mostly above the slower moving average. So when we subtract the slower one from the faster one, you'll get up a positive number. So let's try it on the current values of the moving averages. So let us subtract the 26-day average from the 12-day average. So we are getting the number as negative 73.8, which means that the slow moving average is right now above the faster moving average since the price has gone through a small downtrend. So this is the MACD line, the difference between 26-day exponential average and the 12-day exponential moving average. Next comes the signal line, which is orange line on this chart. This is a 9-day exponential moving average of the MACD line itself. So it is the average of the MACD line itself. It will help us to see signals going forward. And the last thing is the histogram, which you can see here in green and red color. It is nothing but the difference between MACD line and the signal line. So a positive number on the histogram is telling us that MACD line is above the signal line and the red bar tells us that MACD line is below the signal line. It is more like a pulse of the MACD. Now let's look at how to use MACD. The very first way is to look for bullish and bearish crossovers. So the bullish crossover is when the MACD line crosses above the signal line. So let me highlight that for you. So as you can see, here is one bullish crossover which has resulted into an uptrend, and there are opposite of that like a bearish crossover that result into a downtrend. So this is a very basic way of using it. One can look for bullish and bearish crossovers across time frames. Now this is a daily chart. One can try to look it on any other time frame. So let me show you on weekly as well. So this is a weekly chart. As you can see here also, you are able to see when the MACD line crosses above the signal line, it is a bullish crossover, and when it crosses below the signal line like this one is a bearish crossover. The second thing people look for in MACD indicator is divergences. So there are two types of divergences. First is bullish divergence. So a bullish divergence is when the price makes a lower low but the indicator makes a higher low. So as you can see, here is one example on the Nifty. Here Nifty index made a lower low but the MACD indicator made a higher low. It did not make any lower low, which resulted into a big move like this. So this is known as a bullish divergence, and the opposite of that is a bearish divergence when the price makes a higher high like this or even this, but the indicator makes a lower high. As you can see, indicator did not make a higher high along with the price. So this is a negative or a bearish divergence. So we discussed crossovers and divergences. Next comes up using the zero line. Now, as you can see, let me clear all of this. Just for reference, I'll draw a zero line here. So as you can see, the MACD line goes and comes back below zero. It crosses up and then comes back below zero. So this can be known as a one cycle. So these are like sine waves going up and down of the zero line. So this whole thing can be created as cycles. So as you can see here, one cycle has started, which has lasted all this while and ended. So the whole move can be considered as one cycle, and then again when it goes above zero and comes back below zero, it can be treated as one cycle. And then you can see from this point till it goes back above zero is the whole one cycle. So till it hasn't gone above zero, the down move hasn't actually ended properly. So there are three ways that we discussed. One is bullish and bearish crossovers. The second is looking for divergences. And the third is going above and below zero. Now, how do you scan for bullish and bearish crossovers on day-to-day basis? It can be a lot of a task to go to all the charts and scan. So that has been made easier in the MACD scan within technical scanners on Strike. So what you can do is go to the scanner and choose your particular basket you would like to see it on and choose your time frame. So as of now, I'm using FNO baskets and indices, and I've chosen the daily time frame, and I'm filtering for buy crossover, which means the MACD line crossing above the signal line. So these are the results for today. You can go through and look for proper signals. So this is the chart of, as you can see, Nifty Auto. Now the MACD line has crossed above the signal line by going below zero, and the MACD histogram has also turned positive. So this is a perfect example of a bullish crossover. You can look for all the setups that are happening currently during the day, and the best part is that you can look the same on different time frames. So if I go to weekly, I'll get to see weekly signals. If I go to hourly, I'll get to see hourly signals. Now same is the case with bearish crossovers as well. You can choose sell crossover, and if there is no results, it will show up like this. Let me try on weekly if there are any. So yeah, on weekly we are seeing quite a lot of sell signals on the MACD, which means the MACD is going below the signal line. Now, as with any other indicator, you can combine MACD with other tools to improve the strike rate drastically and filter out bad signals. So here I've applied a simple 20-day average, which you can use along with MACD. So I'll highlight a few examples here that I see. So as you can see here, let's begin from here. Here the MACD has given us a bullish crossover, and the price has also crossed above the 20-day average, and it is staying above the 20-day average, and we have seen the trend continued. Now let's talk about some opposite scenarios. Now what you can see in this time period is the MACD has given us multiple buy signals, 1, 2, 3, but all these have not worked out. And what is common in all this is price wasn't able to stay above the 20-day average more than 1 or 2 candles. So as you can see, 20-day average was not being held on closing basis properly. Now then again, fourth time when MACD gave us a bullish signal, the price continued to stay above the 20-day average. So a simple tool like 20-day average helped us to filter out bad signals and stick with the good signals. Now this is just one example. You can combine it with any other period moving average or any other trend following tool.